Hi, welcome to Chapter 2, which is going to be on the financial market and the environment in which companies make their financial decisions. First, let's talk about some definitions. When we look at our companies, our corporations, they generally need money from outside sources. They don't generate enough money to fund all their projects, and even if they do generate enough money, very often it's a wise decision for them to use someone else's money to do their new projects, new products, capital improvements, that kind of thing. So they have three choices when they need that external funding. They can go through a financial institution, they can go through the financial markets, or they can go through private placements, and we're going to talk about each one of those in turn. Financial institutions, by definition, are intermediaries. So these are the people who take the money from the haves to the have-nots. So when you and I decide to save our money, somebody else uses that money to do an investment project or whatever it is they need to do. So generally speaking, individuals are the ones who supply funds in our economy, and businesses and government are the ones who use funds. So when you walk into your bank and you put your paycheck in your savings account, you put $1,000 in, that doesn't sit there in a drawer with your name on it. Instead, the bank takes your money and a lot of other people's money and then loans it out to companies and sometimes to other individuals to do whatever projects they want, and then the bank makes money by charging a difference between those, between what they pay you in interest and what they receive in interest from those that they loan it to. So that's how, what keeps our economy working is that flow of funds. If all of us just kept our money under our mattresses, it would be very hard for the economy to expand and grow because they wouldn't have access to the funds when they need it. So let's talk about some of these financial intermediaries. First of all, we have commercial banks. These are the banks that you're familiar with. They provide savers like you and I a secure place that's generally FDIC insured to put our investments, and we'll loan out money to small businesses, to individuals if you want a home equity or a mortgage or an auto loan. So these are your HSBCs, your key banks, those kind of institutions. Then we have investment banks who are more like the corporate banks. Investment banks are the bigger banks that help corporations with their financial expertise needs. So they help them raise capital, issue stocks and bonds, mergers and acquisitions, things that are kind of specialty finance that the company may not have that much expertise in it because they do it so infrequently, but the investment bank has a lot of expertise in. And we'll talk more about investment banks as well. Primary market, when we talk about how the markets are divided, we talk about the primary market as being where new securities are issued, and the secondary market being where existing securities are traded. So in other words, when Facebook went public and decided for the first time they were going to issue stock, they did that in the primary market, and that's where Facebook got their capital. If you and I now own Facebook stock and we decide to trade it, we're trading in the secondary market. So somebody already owns the stock and is trading it to somebody who wants to buy the stock. Facebook, the company, doesn't make money off of that transaction. It's important for them to keep tabs on how their stock is doing, but you and I trading our stock to somebody else doesn't make Facebook money in the secondary market. We can also talk about the length of term in the markets, and we split that into the money market, which is short-term securities, generally things that are going to be liquidated to cash in under a year. The most typical money market instruments we talk about are U.S. T-bills, commercial paper. These are all called marketable securities, meaning they're very liquid, very short-term, very safe, short-term CDs, that kind of thing. If you ever go into your bank and hear of a product called a money market deposit account or a money market checking account, that's what they're investing in. They're doing short-term instruments. They're typically able to pay you a little bit more than your passbook savings account because they give you some restrictions on those accounts, but still a very safe, very good investment for you to put your short-term money in. Then we move on to the capital market, which is where we do longer-term stuff. So in the capital market, this is securities that don't expire in the next year. Even if we intend to get rid of them in the next year, as long as the security itself isn't going to be liquidated in the next year, it's the capital market. So the capital market is where we trade stocks and bonds. Okay? Bonds are debt instruments. Remember this from your accounting class. Bonds are when we owe, the company owes us money. We've purchased a bond and they have to pay us back. We are creditors of the company. Stock is when we are owners of the company. We've bought a share in the company. And we can have common stock, which is our general equity, or we can have preferred stock, which has some advantages to it that we'll talk about later as well. The New York Stock Exchange is the world's largest stock exchange. This is where the majority of stocks are traded that you hear about on the news. Okay? Certainly not the only stock exchange. Stock exchanges exist all over the world. The next largest to the New York Stock Exchange is London, and then they're in every other major country around the world. So stocks literally are 24/7 business all around the world. The New York Stock Exchange trades stocks, not bonds. So we'll talk later about markets where bonds are traded. So what does the capital market do? The capital market, again, is getting money from those who have it to those who want it. It allows money to move around, allows companies to do the projects that they want. From the role of an investor, we are hoping that the market allows us to make a little bit of an extra return, but we also expect that the market is a fair and safe place to do our investing. So we talk about the term efficient market. An efficient market means, by the forces of capitalism, our money is being channeled to those who need it the most, and the investment that we get is fair and it's represented accurately. Okay, so what we generally mean there is it's a bidding system, right? So the highest price, the market will correct to where it should be. So if you and I want to buy a certain stock, the price we pay for it is this price that the market believes it's valued at. Okay, it's not something artificially created. It's not something that insiders have gotten their hands on and artificially set prices or colluded to make the price higher than it should be. Our markets are supposed to be efficient, which means buyers and sellers come together and determine the price, and all of us have access to all the information that goes into the price. Our markets are actually pretty efficient. There's, I'm sure, some room for improvement, but the U.S. capital market is a pretty darn good one. So let's talk about some ethics issues, because if you've paid attention at all in the last few years, there's been quite a few when it comes to the markets. Martha Stewart, you guys remember what she did? She was convicted of conspiracy, obstructing, and making false statement. She actually went to jail for 5 months, and then she was home confined and paid some money. She was accused of insider trading, which violates our tenet of having an efficient market, because it said Martha Stewart got to trade her stock with information that the rest of us couldn't get because of her close relationship with the owner of the particular company whose stock she had. So insider trading is illegal, and it was enforced in the Martha Stewart case probably so that she could be an example to others, because of her celebrity status. Insider trading is something that occurs, but it's something that the government has been watching a little more closely, and it certainly is hard when you are an insider to not insider trade because you already know the information. And the way the government gets around that is by forcing insiders to disclose their trading, so that you and I know the president of a company is cashing in their stock options. That could tell us that it'd be a good time to buy. Okay, some other things about the markets that we need to know. Couple term definitions. Securitization. Securitization is when we take mortgages or loans and pull them together. And what we do when we pool them together is we come up with a way of selling a product. So let me explain that for a minute. Securitization, if a whole bunch of us have mortgages and we are all paying the bank, our monthly mortgage payment, the bank takes all of our mortgages, bundles them together, and then sells off shares in that mortgage generating business. Okay, so that mortgage security is tradable, and it allows somebody to make some money. How do I want to say this? To make some money in a way that they couldn't directly without taking on risk. So let me rephrase that again. So when we have a mortgage-backed securities, for example, you and I all pay in our mortgages. Somebody bundles those and sells them off. Now they don't have the risk of one particular mortgage defaulting. They just have shares of a big pool of mortgages. The problem is, and this is what created a lot of problems in our country, is the further removed you are from the person who's paying you back, the more risk you undertake. So if you think about it, if you go into your local bank and you sign up for a mortgage and you're sitting across from Joe, the mortgage lender, okay, and Joe knows he's got to collect personally your mortgage for the next 30 years. He's going to be really careful about making sure that you fit all the requirements, that you have the income stream, that you're a reliable person, that your credit's good. He's going to check into that very, very carefully, because his job is going to depend on collecting that money from you. His paycheck is going to depend on it for the next 30 years. So he's going to be really careful. If, however, Joe knows that all he has to do is get you to say yes to a mortgage, and then he's going to sell off your mortgage to somebody else, and he doesn't have to collect it. He knows he's going to make money the day he sells it off. His incentive to check you out really well just went way down. And that's exactly what happened in the mortgage crisis in our country. We said, oh, we'll create these mortgage-backed securities where we bundle them and sell them off, and all of a sudden the banks and the lenders realized, hey, we can lend to anybody because we just sell it off and then we never have to deal with collecting it. The fact that they can't pay us back or the deadbeats, that's somebody else's problem. And that's exactly what happened. So we'll talk more about that in a second too. Here's a nice chart that says what the values happen, and those of you who had houses in 2008, and if heaven forbid you wanted to sell it, you probably learned this intimately. We had this thought that housing was just the wonderful investment and the housing prices only ever increased, and then we had a huge dip in housing prices because of these delinquent mortgages. People weren't paying, banks were foreclosing, you could get these houses super cheap, so why would they buy yours for more money? Housing values just went down considerably. It was a huge crisis, and it led to an economic crisis, because if housing values go down, then people aren't buying houses, they're not doing improvements, they're not hiring contractors, they're not paying those people the money, so those people aren't in the restaurants. It's just a big vicious cycle. So let's talk about some of this spillover and what happened with the financial crisis. The banks came under a lot of pressure. The government acted because, really, if you recall, during that time, it wasn't a very nice place to be in our country in terms of economics. So the banks got in a lot of trouble, and they had to tighten their standards and change how they made their loan procedures, really go back to enforcing the rules that kind of were already there, right? And corporations, though, because the banks tightened up, they got into so much trouble and they tightened up, it became harder for legitimate people to get securities, to get their loans as well. So corporations couldn't necessarily have access to capital. If corporations don't have access to capital, they can't expand and do new products. They can't expand and do new products, they're not hiring people, and they're not spending money. All that creates a lot of problem. Okay, so we had a lot of businesses that were hoarding cash, not spending money, no economic growth in our country, and a lot of trouble. Okay, so another term you need to know is the, well, you probably already know, the Federal Deposit Insurance Corporation, the FDIC, which is the ones who provide the insurance on your bank accounts and things that you do so that you, in case of a bank failure, you would be made whole. They also had the Glass-Steagall Act, which is what established that. But in addition, so that's a very good thing, established the FDIC. In addition, that Glass-Steagall Act had prohibited institutions that were deposit companies, like regular old banks, from doing investment banking activities. So you couldn't have the same bank do consumer banking and do investment banking. And that was considered to be a key protective part of this act in response to the Great Depression. Okay, it was considered very important for the security and safety of banks to separate those two activities. So what happened in 1999, we had kind of a repeal of that said, okay, now you guys can do different things. Okay, so your commercial bank can do some investment banking. They can help you with insurance. You know, they can, if you ever walk into your bank now, they try to sell you a million different products, right? So they can do all this kind of stuff. It was considered to be a progressive way to allow for more competition, and you know, had all these good things associated with it. But what happened? It had a huge negative impact, is what led to the mortgage crisis. We had these banks that were considered to be too big to fail. And because they did so much, and they were in commercial banking, they were in investment banking, they were in insurance, they were all this, it ended up being the crisis that we had in 2008. Rather than the market being able to correct itself and allow a few banks that didn't follow protocol to fail, instead these companies were so big that their failure could have, you know, caused millions of people to be unemployed, and the government had to step in and bail them out. So some folks have said, you know, let's get rid of that, 1999 Act and go back to Glass-Steagall. So again, as part of the response to the Great Depression in 1933, 1934, the Securities Act and the Securities Exchange Act, we had some of those provisions we just talked about. We also had the Securities Exchange Commission developed, which are the people who are supposed to be regulating companies. Okay, those are the people who have to, you know, get your 10K forms, your 10Q forms, the things you have to submit to them. They're supposed to be looking for insider trading, securities fraud, catching all that kind of stuff. As we'll go through this course, you'll see a whole bunch of examples of ways that the SEC has not quite lived up to that charter and has struggled. And we'll look at what that's caused for our economy and some of the trouble that we've gotten into. So I hope this gives you a little bit more understanding of how the markets work. It's a lot to bring in a short amount of time, but we will have plenty of time as we go through the course to talk about it more, and I think by the end you'll feel pretty comfortable reading the business section of the paper or picking up the Wall Street Journal.